In a world where change is the only constant, Mo Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey.
Welcome to the Deep Dive. Today we are taking a sledgehammer to one of the most technical and honestly intimidating products in modern finance.
Yeah.
The reverse mortgage.
Right. And we're going to be focusing on the big one, the federally insured home equity conversion mortgage. You'll hear it called a HECM.
The HECM, yeah.
Our mission today is, I think, pretty critical. We need to get past the simple definitions you see online and really get into the mechanics, the regulations, the servicing rules, and the very unique closing complexities.
Especially for title work. I hear that's where things get messy.
That's where people really get tripped up, yeah. If you work in real estate or estate planning, these are the details you absolutely have to know.
Absolutely. And just to start, it's fun to remember how young this product really is.
It's pretty recent, yeah.
The idea came from a bank in Maine way back in 1961, but the regulated system we're talking about today, that didn't even exist until 1987.
Right. That's when the Housing and Community Development Act created the HECM program.
And put it under HUD, the Department of Housing and Urban Development.
And think about that. It took the government more than 2 decades just to formalize a structure for this kind of debt.
A loan where the balance grows instead of shrinks.
Exactly. And that context, that history, it explains why the HECM is just layered with so many rules and these mandatory consumer safeguards.
Okay, so let's unpack it. Let's start with a working definition. A reverse mortgage is, it's a loan for senior homeowners.
You have to be 62 or older.
Right. And you have to own your home outright or pretty close to it. It's secured by your equity. And the famous part is you don't make monthly payments.
Generally, yeah. Repayment gets deferred until the last borrower dies, sells the home, or just stops living there as their main residence.
And you can get the money in a few different ways.
You can. A lump sum, monthly payments, or a line of credit, the LOC, as it's often called.
Now, that brings us to a huge fork in the road. There are different types of these loans.
There are, but we're really focusing on the FHA HECM today because, it's the gold standard.
It's insured by the FHA.
Right, and it has to follow those really strict consumer protective HUD guidelines. That includes things like mandatory counseling for the borrower.
What's the alternative then? I've heard of conventional or proprietary reverse mortgages.
You have, and they're offered by private lenders. On the surface, they can look pretty appealing.
How so?
Well, they can often go above the FHA lending limit. For reference, that was about $680,000 back in 2018.
So for high-value homes, they might seem like a good option.
Exactly. And they might offer, slightly more flexible terms or maybe lower upfront costs. But, and this is a huge but,
okay,
the critical drawback you have to remember is they lack the security of government insurance. They have way fewer consumer protections.
So if that private lender goes under,
you don't have HUD standing behind that agreement. You're on your own.
This is where the story gets really interesting, with the government stepping in and making these rules even more complex.
Oh, yeah. Lending peaked around 2008, 2009?
About 110,000 loans a year. But that boom exposed some serious flaws.
It was a systemic problem. A lot of those borrowers, they took the full lump sum, spent it way too fast, and then
they couldn't keep up with taxes and insurance.
Right. They started defaulting. It was a huge foreclosure crisis, ironically, for people who were supposed to be secure in their homes.
So the government basically slammed the brakes on that.
They did. In September 2013, they merged the HECM standard and saver options, which lowered how much people could borrow. But the biggest change, the biggest disincentive, involves the mortgage insurance premium, the MIP.
And this is a great example of regulation trying to force responsible behavior.
It really is. So if a borrower wants to spend more than 60% of their initial credit limit in that very first year,
the upfront mortgage insurance premium jumps.
It jumps from 0.5% to 2.5% of the home's appraised value.
Whoa, hold on. Let's pause on that. That's not just a little nudge. That's a huge financial penalty for taking too much too soon.
It absolutely is. I mean, think about a home appraised at $400,000. That 2% jump means you're paying an extra $8,000 in mandatory fees.
Just because you needed the cash too fast.
Exactly. And that rule, it fundamentally changes the product. It's not an emergency cash machine anymore. It's a structured retirement income tool.
Okay, so they tighten the rules up front. But what happens after the loan closes? How does HUD make sure people don't just, forget about taxes and insurance again?
That takes us into servicing requirements, specifically something called LESAs.
LESAs.
Life expectancy set-asides. They're for taxes and insurance, and they're a direct result of that foreclosure crisis we mentioned. It's money set aside just for those property charges.
That seems smart, but I'm guessing it's not one size fits all. You mentioned two types.
That's right. The first one is the fully funded LESA. This is required if the borrower has a poor credit or payment history. It doesn't matter what their income looks like.
And in that case, the money's just held back.
It's fully reserved, and the loan servicer pays the taxes and insurance directly for the borrower until that LESA fund runs out.
Okay. And the second type, it's a bit different.
Correct. That's the partially funded LESA. This is for when the borrower has a good payment history, but their residual income, the money left after big expenses, is just too low by HUD standards.
So this one is more about boosting their income.
Exactly. The borrowers get semi-annual payments to help them out, but they are still personally responsible for paying the T&I charges when they're due.
That's a really critical distinction. What's the biggest trap with these LESA funds that people need to know about?
The funds are totally restricted. You can't touch them for any other reason. And crucially, they are not available to a non-borrowing spouse after the borrower dies.
Wow. So if there's money left in the LESA, it just goes back into the estate.
It reverts back to the equity pool.
So
it's a huge detail that spouses and estate planners need to understand from day one.
Okay, let's talk about ongoing compliance. What does a borrower have to do to keep the loan in good standing?
The main thing is the annual occupancy certification. You have to certify every year that you still live in the home.
What if you're away for a while?
You have to notify the servicer if you're gone for more than 2 months, though there is a medical exception that allows up to 12 months.
And what if you just forget to send in the form?
That's a default. And the second the loan goes into default, any line of credit funds you had access to are immediately frozen.
So if you had a $50,000 line of credit and you die or default with $40,000 left, that's just gone.
It's gone. It's not added to the estate. It's not added to the loan balance. It just vanishes. Now, the flip side is that while the loan is active, you can make prepayments and reborrow 100% of them.
As long as you keep a small balance to keep the line of credit open.
Right. You have to keep a nominal balance.
All right, let's turn the page to the really technical part.
Yeah.
Title and closing. This is where things look nothing like a normal loan.
And what's so fascinating here is how the whole structure is built to minimize HUD's risk. It starts with this dual mortgage system.
2 mortgages.
Historically, yes. HECMs required 2 mortgages and 2 notes, a first one for the lender and a second subordinate one for HUD.
Why does HUD need a second lady?
It's their security. That second note secures any payments HUD has to make if the lender defaults or if the loan balance ends up being more than the property is worth. It's HUD's collateral.
So they're always protected.
Always. Now, HUD no longer requires that second note on fixed-rate loans, but that structure really shows you how deeply they're involved.
And what about the paperwork? Do these loans follow the modern disclosure rules?
Surprisingly, no. Reverse mortgages are explicitly not subject to TRIDE.
The Tiller-RESPA integrated disclosure rules?
Not at all. The complexity of future advances and a balance that's always changing just doesn't fit into that standard TRID model, so they're still using the old form.
The good faith estimate and the HUD 1 settlement statement.
You got it. They're living in the past, documentation-wise, and those documents are incredibly date-sensitive.
What do you mean?
All the closing docs have to be executed on the exact day of closing. Not the day before, not the day after, get it wrong, and the whole package could be void.
That's a level of pressure you just don't see in standard mortgages. Now let's talk about the money. The loan amount versus the title insurance. Why is the recorded loan amount often so much higher than what the lender will insure?
This is a massive trap for professionals, especially title agents. State laws often require the mortgage amount on the county record to be 150% of the maximum claim amount, or MCA.
150%. Why?
To account for everything that's going to accumulate over the life of the loan, the interest, the servicing fees, the MIP. It makes sure the lien can cover the potential maximum balance 30 years down the road.
But the title policy is different.
Yes. The title insurance policy itself only needs to be equal to the MCA, not that inflated 150% amount. You're insuring what the borrower can actually draw, not the theoretical ceiling.
Which brings us to specialized title insurance. You need a specific endorsement for this, right?
You absolutely do. It's the ALTA Endorsement 14.3, the Future Advanced Reverse Mortgage Endorsement. It's essential.
Because a standard policy just assumes a fixed loan amount.
Exactly. But the HECM is a revolving line of credit. You might draw money 10 years from now. That endorsement protects the lender's priority, not just for the money they gave out at closing,
but for all the money they might give out in the future.
Precisely. It insures against loss of priority because of those future advances or interest adjustments. It's built entirely around managing that fluctuating lien.
So before you even get to the closing table, what needs to be cleaned up?
Everything has to be spotless. All property charges, HOA dues, taxes must be current. Tax deferral programs for seniors, strictly not permitted.
And any old liens?
Prior mortgages, IRS liens, judgments, they all have to be paid off at closing. The good news is they're paid from the loan proceeds. You don't have to come up with that cash up front.
Let's move to the final trigger event. Loan maturity. This is when the last borrower dies or an eligible non-borrowing spouse is gone, the heirs get involved.
Right. So if there's no eligible non-borrowing spouse, the heirs get a due and payable notice. They usually have 30 days to respond, but that can be extended up to 6 months.
And if they want to keep the house?
Simple. They have to pay the full loan balance.
Okay. And if they choose to sell?
If the house sells for more than what's owed, they pay the debt and keep whatever is left over. But what if the property is worth less than the debt?
Which is entirely possible with a loan balance that's been growing for years.
It is. And this is where that non-recourse feature, the FHA insurance, kicks in. It's a massive consumer protection.
So the heirs aren't on the hook for the difference.
Correct. If the house is upside down, the heirs can sell it for at least 95% of its appraised value and walk away clean. The FHA insurance that the borrower paid for covers that shortfall.
That 95% rule is crucial.
It is. It means the heirs don't have to keep the house on the market forever trying to get every last dollar if the market is down.
But is that always fair? If the market is dropping fast, couldn't that rule actually lock them into a lower price just to satisfy the lender quickly?
That's a great point. It's a mechanism built for closing out the debt, not for maximizing the estate's profit. Its primary job is to protect the heirs from being sued for the shortfall. But yes, it does pressure a quick, efficient sale.
Now, let's talk about the protections for an eligible non-borrowing spouse, or NBS. This was a huge update from HUD.
A huge consumer safety feature, yeah. It came out of court cases and was updated in mortgagee letters in 2014 and 2021. But the eligibility is extremely strict.
What are the requirements?
They have to do the mandatory counseling, be listed on the loan, be legally married to the borrower at closing, and stay married, and live in the home as their primary residence.
If they kick all those boxes, what's the protection?
It allows the NBS to stay in the home during a deferral period. This happens after the borrower dies or if the borrower has to move into long-term care for more than a year.
So the loan doesn't become due and payable right away?
Correct. As long as that NBS keeps paying the taxes and insurance and maintaining the property, it's a huge peace of mind for older couples.
But how easy is it to lose that status?
Very easy. Moving out, getting a divorce after the loan closes, or remarrying, any of those will cause an immediate loss of NBS status.
And the loan becomes due instantly?
Instantly. And a new spouse can't just become the new MBS on that existing loan.
This deep dive really makes it clear. The HECM isn't just a mortgage. It's a government-backed financial tool, layered with regulations designed for stability, but it demands so much diligence from everyone involved.
That sums it up perfectly. And that complexity, it lasts even after the loan matures. Just try getting a payoff quote.
It's not straightforward.
It's a bureaucratic nightmare. Unlike a regular mortgage, you almost always need faxed written authorization. And the quote is usually only good through the end of the current month because the interest accrues daily on that growing balance.
And it's worse for loans in default.
Much worse. They have significant fees added on, and the good through dates can sometimes be just a few days.
So given all this, the mechanical complexity, the technical rules for title, the freezing of credit lines, the strict spousal rules, how might proactively educating estate planners and potential heirs about these specific requirements become the most valuable service you can provide to ensure the borrower's wishes and the loan's integrity are actually maintained.
In a world where change is the only constant, Mohs Shamil stands at the forefront, guiding title professionals to not just grow their businesses, but to master the art of innovation. With every episode, you're handed the keys to unlock unparalleled growth and stay ahead of the curve. Get ready for a transformative journey